Hey guys, welcome back to Ivy Crypto. Hope you're all having a fantastic day. I wanted to make a video on this Friday about some trading signals for beginners and just talk about some of the key things that you need to look for if you're considering trading or doing some short plays in cryptocurrency. Now, as always, this is not financial advice and I am not a financial advisor. I just wanted to put out there some tips. I've got some documents here that I want to talk to you through, and this can be quite complex, guys, and sometimes hard to understand. I know personally it took me months to really get my head around this and understand it fully. So I've got these here to just try and make your life a little bit easier, but I still recommend doing plenty of research and trying this out with not a lot of money just so you can get your head around it. So let's just get right into it. So tips using candlesticks. Okay, now obviously the candlesticks are the indicators on the crypto charts. These can be found on CoinMarketCap, on CoinGecko, but also on the trading platform that you're using. So if you're in Australia, that could be SwiftX, you could be using Binance, and obviously overseas you got Coinbase and a bunch of other exchanges as well. So context and location. The current candlestick must always be compared to the previous price action. An individual candlestick is absolutely irrelevant if it's not taken into the bigger picture. You wouldn't want to short a gravestone doji at HDF support and etc, etc. Identifying patterns, timing your entry and all that sort of stuff. It's basic, but when combined you can literally create a trading strategy out of this. Patience and a basic understanding of candlesticks, patterns and trigger points can change absolutely everything. So I've got a couple of points here to talk about. So point one is healthy upwards trend with price action above the EMA. Then you've got successful morning star patterns, which is here, here, and here. Then you've got the congestion zones have formed in this uptrend, but this is the first time consecutive congestion zones formed around the same price level. Then you've got the first time a bar formed completely below the EMA, and then you've got a failed morning star. So those are just 5 of the key things to look for, guys. Now, the size of the candle can tell you a lot. You always wait for the candle to close, but candle size can tell you a lot about strength and momentum. Larger candles signify a stronger trend in either direction to be up or down. Smaller candles at the end of a trend signify a weakening trend and a possible consolidation or reversal. Wicks should be taken into consideration along with the context rule. If we have large wicks into high time frame supports on the daily, for example, this signifies demand at this level and we could be in for a possible reversal. Wicks will usually show rejections from key consistent levels. Long wicks will happen often at the peak of a trend or at the lows and are a good sign to watch out for once it's closed. The body of the candle shows the distance of the price has traveled from open to close. A series of large bodies signifies a strong trend. Small bodies with no wicks show lack of interest, whereas large candlesticks with large wicks to either the upside or the downside signify high volatility. So evening star candlestick with moving average. So right number 1, you've got context. Attempts to stay above the EMA was unsustainable each time. So you've got here and here. Number 2, you've got bearish pressure, top shadows. Number 3, you've got bearish evening star pattern rejected by a previous gap and the MA. Right here. And then number 4, the market pushed below this gap support without hesitation, a bearish sign. Now obviously remember, guys, bullish is good, bearish is bad. We want to buy red, sell green at all times. So these are some of the first tips I wanted to show you guys. Now up next you got patterns, and I know this is very confusing and we've got a lot here, so I'm not going to go super into it, but I do want to talk about it. So patterns are key to trading. Having a good eye and being able to spot patterns the second you open a chart should be everyone's goal. They aren't hard to spot, and the second you begin to understand them, they literally scream at you as they begin to form on the chart. I've provided all of the key patterns, how they unfold, and remember, the higher the time frame, the more validity the pattern holds. For example, a falling wedge on the daily would be more reliable than a falling wedge on the 15-minute chart. We can expect it to take longer to play out, but we can also expect the move to be bigger when it happens. This is the same principle for all patterns. Remember, patterns don't always play out like they should. Nothing is certain in trading, and that's for sure. Confirmation is always a break of the structure, be it on the upside or the downside, and the trigger is the breakout and you enter on the retest. So let's have a look at some of these here, guys. So like I said, I'm not going to go heaps into it, but here we've got some reversal patterns, continuation patterns, bilateral patterns, and some reversal chart patterns. So there is quite a lot here, and it can get really confusing, but bullish patterns, bearish patterns, reversals. So right here, let's look at some of the bullish ones. So bullish is obviously it's going up. So in this wedge here, you want to buy. Same as this wedge, this wedge, this wedge, this wedge. And bearish, which is when it's going down, is when you want to start to sell. So the flag, the pennant, the 3 rising valleys, the 3 descending peaks, the descending scallop. There's a bunch of different names for these. So I definitely recommend going more into it, obviously when you do your own research. But these are some of the patterns that you want to look for. And when you're looking at charts, and like I talked about in this document, once you're looking at the chart and you understand these and you get your head around it, it will make so much more sense and you'll spot them straight away. So now we've got candlestick patterns, and obviously this is a little bit more in depth, but I'll talk you through it, in a timely manner. So candles, just like generic patterns, can have meaning within. I've shown some examples of some common candlestick formations that we see regularly, and you should always wait for the candle to close, as the whole picture can change within a small period of time. Candlestick patterns, used along with other things such as support and resistance, pattern formation, etc., can be a very powerful tool for finding entries. The higher the time frame of the candle, i.e. the 4 hour, 1 day, 1 week, the more we can trust. So obviously you can edit your charts to look at the hourly, the minute, the 5 minute, the daily, the 1 week, the 1 month, all that sort of stuff. And that's what you really should be looking at, especially when you're learning. So here we've got some bullish candlestick patterns, and they've all got different names, as you can see, but this is what you want to see when you're picking an entry point. Then you've got some bearish candlestick patterns, and this is where you want to exit your position. Obviously, bearing in mind that, pun intended, you want to be at a point where you're happy to exit, and obviously you haven't lost too much money, and trading is a pretty slippery slope when it comes to that. So more to look out for here, and more stuff that you can individually research as well. And then you've got timing your entries. So this is really the key here, guys. As I said previously, you want to buy red and sell green. That is absolutely the goal. You do not want to buy when things are peaking. You don't want to buy when we're in the midst of the bull run. Not if you're trading, and definitely not if you're looking to make some profits in a decent time. So entries should always have a specific criteria that's met beforehand. They're called trigger points. An example of trigger points: a breakdown of a downtrend. If the retest holds on the HTF, this is the trigger to long. A breakdown of support, the retest of the broken support, would be the trigger to short. So shorting is the act of betting that the price will go down, and to long is betting that the price will go up. So this is a key thing in trading, and I personally don't suggest doing that sort of trading myself. Day trading is one thing and all that sort of stuff, but shorting or longing the market, and borrowing money to do it is definitely not something you should do, especially if you're a beginner, and you can get in a lot of trouble with borrowing to do that. So choosing an entry point is key to all your trades. Rubbish entry is a rubbish trade. Try the below triggers for efficiency and maximizing an opportunity. A break above and retest of a HTF EMA, like EMA 200, on the 1 day support resistance flip / reclaim of lost support on the HTF, i.e. 1 day. So here you can see what a chart can look like. Broke support, resistance, and then it flipped the support and up it went. So more of that up here. You got old resistance, price flips to hold a new support, etc., etc. So a lot of stuff to go into, guys, as I said at the beginning of the video, but all important stuff. And here you've got some of the EMA 50s and the EMA 200s, and they're the only ones that I use, and there's some rules around these, and I think maybe in this video it's probably not appropriate to talk about it too much, but there's some basic rules, and the indicators should not be used solely for entries. They should be used in conjunction with other methods to confirm your bias. Indicators on low time frames should be ignored unless you're day trading. Always use high time frame indicators for reliability. The golden cross is the EMA 50 crossing the EMA 200 to the upside, and the death cross, which you guys would hear a lot, is the EMA 50 crossing the EMA 200 to the downside. These are lagging indicators and usually occur late. However, they can be used to confirm bias for larger swing plays, and once the price action is trading above EMAs like these, they flip from being resistance to becoming support, like you can see in some of these here. So the death cross, we saw this a couple of months ago, we've seen it a couple of times this year actually, is a major sell-off. And then you've got here when things are going green, and there's so many different types of patterns and so many candles and winks and all that sort of stuff, but it's important to get a basic understanding of this. And then you've got a couple of other things I wanted to mention, and these look pretty confusing. So again, if you are a beginner, some of these are not relevant to you. But your silver is your market is completely uncertain of direction. Your green is a bullish trend. Your red is a bearish trend. And this indicator is amazing for macro trends. Okay, so here you got it. Like we said, guys, remember silver market is completely uncertain. Green is good, red is bad. Okay, so you've got some of that green here, and then you've got the red here, which is bad. You do not want to be in when this is happening. But the fast EMAs turning silver during a confirmed downtrend most often gives you a sign that a bounce is currently going. It's good to use this bounce as a selling opportunity, especially on a higher time frame like the weekly, daily, or the 4-hour. So this one was very interesting. Now you've got indicators and EMAs, which you've heard me mention before. And I do want to clarify what these means because I think it's important to understand it all. So I prefer using the KDJ to the MACD personally. It seems to show a better reflection of when price action needs to retest. MACD, for example, can cross bullish and absolutely nothing happen. So you can, the KDJ of course, but I feel it's a more reliable tool to be used along with other triggers to support your bias. The KDJ seems to move better in relation to price, often when you're about to get a bull cross on the one day MACD. The KDJ will show price action isn't quite ready to move as yet, as the KDJ needs to reset. Just like the MACD, however, during a flat market, the KDJ can also give off false signals. Therefore, use this on a higher time frames and in conjunction with the indicators. Remember that no indicator is capable of providing accurate signals 100% of the time, and from time to time, even the best will fail, leaving you with a losing deal. No matter what kind of indicator you rely on, don't forget to follow basic risk management and capital allocation rules. So I talked a little bit about this in previous videos about risk management and knowing when to pull out and knowing when to stop, but it's important to do that in trading more than anything. Now up next, we've got my favorite thing to talk about, and that is taking profits. And this is a very, very key part. So if you're going to listen to any part of this video, this is the part you want to listen to. Profit taking is the one area of trading which many struggle with. Why? Because it's influenced by many different factors, most of which rely around emotion. Euphoria is the main one. Will it go higher? What if I miss an extra profit? These are all issues which need to be understood and noticed in the moment. 90% of the time you're encountering these thoughts, usually there's a valid argument to take a percentage off the table. Below is a good profit-taking strategy to ensure you compound gains and don't leave winning trades on the table. Each winning trade should be split. 33% into your spot portfolio, 33% into your USDT store, and 33% into your long-term holdings. Another good strategy is to pull profit relatively to the move, i.e. a 30% move, pull 30% of the position. A 50% move, pull 50% of the position, etc., etc. Yes, trades may run higher, but this will always be a possibility and should not be a reason to disregard your strategy and leave profit on the table. If you don't pull profits, others will, and that is a fact. And obviously when others start to take profit, the market starts to go down, you actually start losing money, not making money. And that's the key one here. So here you go here. For example, you got your stop loss there, you got your entry point here, you're 50% up on your position, and the remaining 50% goes up. So where do you want to take profits? Well, you want to take profits here. You want to take 50% of your profits here, and you want to take the rest here, because you've done absolutely fantastic. And then you got another one. Original stop loss, you open your order here, you got your trailing, you're trailing the stop loss, you're just about to hit it, and then bang, it goes up, and then you want to take profits. And then again here. So first target, you take profit, a third of the position in this area, you want to take profit on the second third in this position, and the third target is here. Major condition for the trade becomes invalid. Close the final third of the position. So you're entering here and you want to take profits at 3 points. Now, obviously, if you don't hit that point here and it starts to go down, you want to close the position and get out, because chances are it's going to keep going down, as you can see in this picture. I cannot stress enough, guys, not just in trading, but in your short, medium, and long-term positions, take profits. As a starting point, take out your initial investment if you're doing a medium to long-term hold, and then just play with profits, and that's what you want to do. But with trading, you have to know when to get out, because greed, does kick in, and it can be a funny thing. I've just got one more thing I really want to talk about before I wrap up this video, and that's support and resistance. And these are things that you've heard me talk quite a bit about throughout this video. So I just wanted to wrap up by talking specifically about them. And if you're trading crypto and you don't understand the basics of support and resistance, I've put some of the key points to get your head around, and that's what I'm going to talk about now. And this is a good starting point in the charts. Support is where the price has previously found support and bounced. Resistance is where the price has previously found resistance and struggled. So have a look at these charts while I talk. The higher the time frame, the more volatility, as I've said. For example, support on the 1-day chart will be more reliable than support on the 15-minute chart. It will be harder to break down and therefore provide as good entry points for bounces. The lower the time frame, the less reliable it is. This rule pretty much applies to everything in trading in regards to time frames. But here's some key points. Support and resistance is used to identify areas where the trend may have a short-term bounce or trend reversal. Support is where the price has found demand in the past, and therefore we can expect it to find demand in that area in the future also. Resistance is where the price has struggled to break in the past due to a concentration of supply. EMAs and Fibonacci levels can also act as support. Support can be found through horizontal and diagonal trend lines. There is not just one specific way to draw support. I've shown some examples below. So you got the trend line, the dynamic, and the structure. So here are some of the ways that you can see support and resistance, of course. All right, guys. So I've talked a lot about things today, and just something I want to wrap up, and something that I can't stress enough and is really important to talking about, is that the trading hierarchy is 10% technical, 30% risk management, and 60% patience and emotional management. If you lack patience and can't control and notice your emotions, then nothing will ever progress. TA is the strategy and plan. The execute is the hard part. So that is all I've got for today's video, guys. I hope you've enjoyed it, and I hope I've given you some sort of basic understanding of some of these key signals if you are planning on trading. As always, don't forget to like the video, subscribe to the channel, and watch this space.